Hey guys, UK CPI inflation fell below 5% for the first time in a long time to 4.6%, sending signals that this might be the end of interest rate rises. Looking here at the figures, core CPI inflation, this is stripping out energy, food, alcohol and tobacco, fell from 6.1% to 5.7%. The government are also happy because this means they've met their promise of halving inflation by the end of the year. But what does this mean for your personal finances? Today we've made some notes. We're going to be unpacking what that looks like for you, looking across savings, investing, mortgages, property, and various areas today. If you're really enjoying today's video, really appreciate it, by the way, if you do us one favor of just hitting that subscribe button.
Right, so let's dive straight in. So when inflation rate falls, it doesn't mean that things necessarily become cheaper. It simply means that things are rising less quickly. And one of the reasons for the fall in inflation could be due to the fall in the energy price cap in October compared to the previous year when it was a lot higher. Now, do note that even though inflation rate has fallen a bit, it doesn't mean that everyone's inflation rate will be different because we're all purchasing different things. It's all based on what you purchase.
Yeah, absolutely. And just to mention as well, as Mary mentioned, just because inflation's fallen doesn't mean that we expect inflation to keep falling into the future. In fact, just looking at here, some of the guidance from the Bank of England. The Bank of England increased their forecast of inflation by saying that they expect it to average 4.5% in the first 3 months of next year, then 3.75% in the following 3 months, and then they expect it to hit 3.4% in the last 3 months of 2024. Now, we know these are all forecasts, and forecasts are never ever really correct, to be honest, but it's just worth your while knowing what those numbers are. So with that in mind, here is what the fall in inflation actually means for yours and our personal finances day to day. Do you want to start with interest rates?
Yeah, so let's look at interest rates. At best, we expect the current base rates to remain at the current level of 5.25% well into the next year. However, if oil prices or wages rise significantly more than expected, there may be another rate rise, but this is unlikely to happen. Now, the Bank of England expects rate rises to be at 5.1% in the last 3 months of 2024. And 4.2% by the same period of 2026. So this shows us that even if they decide to start cutting rates in the future, it will be at a very slow pace.
Yep. And speaking to mortgages specifically, and I know a lot of people are concerned about mortgages naturally relating to rates. Now, what the market thinks when it comes to mortgages are usually reflected in what's called swap rates. In simple terms, swap rates basically tell us what financial institutions think about the future of interest rates. This is where we go to look to kind of get a sense for it. And based on our research of swap rates and looking at the data related to inflation data, since Monday, 5-year swap rates have fallen from 4.27% to 4.12%, and 2-year swaps have fallen from 4.78% to 4.66%. This is pretty significant because 5-year swap rates have been above 5%, even as recently as July just gone. So this is definitely pointing to it's likely that we will see a lot more competitive rates coming out, basically, particularly in the 2-year fixed rate market for people who are getting into residential mortgages. In short, what we're saying here is be expectant that mortgage rates will come down a fair bit, which would be good news for people who are trying to get onto the property ladder as first-time buyers or people who are trying to remortgage their properties.
Absolutely. So talking of properties, let's talk on property prices. Now, although property prices have been falling, they're still high, as much as £60,000 higher on average than they were before lockdown in 2020.
Wow.
Now, this remains a buyer's market and sellers are having to reduce their properties, asking prices significantly in order to be able to sell. But in summary, falling mortgage rates will mean more home buying activity, which will drive up demand, and some lenders may even ease their affordability criteria in order to encourage some buyers. So all good if you're looking to buy.
Yes.
But At the time of year, as people start to wind down, most buying and selling activity will cool down and pick up again in January. So now is the time to take another look at your budget if buying a house is on the top of priority for you.
Yeah.
But like Ken said, be prepared for interest rates well below 4%, but with a positive side being that you might be able to drive a good bargain now whilst you can.
Yeah, and just to point out, Mary meant that interest rates well above 4% rather than below. Just wanted to point to that point around property. This is a big thing for people at the minute, isn't it?
It is.
Especially when you look at Rightmove. There's a lot. If you use, there's a Chrome extension you can use. I'm trying to think of the name of it, but it shows you the history of reductions of property prices.
Very insightful.
So there's a lot, like you said, a lot of cutting of those property prices still happening, making it an interesting time for people if you're looking to get into the property ladder.
Yeah, so I would say like between now and the half of next year is a good time to buy, before that competition starts to grow.
Before everybody jumps in.
Exactly.
Looking at stocks specifically, for those of us who, I hope it's everybody, but most people who invest in the stock market, we will likely see a shift in the value of stocks if the Bank of England do start cutting rates, okay? Although, as Mary hinted at there, it's unlikely we'll be seeing that anytime soon. Likely to be in the second half of 2024 at the earliest. This is what the market generally believes from summer next year. Now, if that happens from a stock perspective, this will actually have the impact of pushing up the present value of future cash flows of companies effectively. By doing that, this then pushes up the values of stocks. That's what you'd expect to happen. In addition to that, with any cuts that happen, it makes it cheaper for companies to borrow money, and that money can then be reinvested into companies, helping to further to boost activity. So that's what we expect to happen in theory. From our perspective, Mary and I haven't stopped investing. We've just been investing, whether rates are high or low or whatever.
Still investing.
We've just invested consistently, and we have no plans to doing that, changing that for the future.
Yeah, exactly. So now let's look at savings. So we've passed the peak for saving rates, and we're now seeing a fall in the most competitive fixed rates at present. Now, although the rates won't fall fast, if you're interested in snapping up a fixed rate on your savings, now is a good time to do so. Variable rates will likely stay the same until there are signs that the Bank of England might begin cutting rates, which won't happen anytime soon.
Yeah. I was just going to chip in, by the way, with inflation. I know we talked about CPI. Another measure of inflation worth keeping an eye on is RPI inflation, which, is always higher than the CPI. And as Mary said, every single one of us has a different inflation rate. So anyway, yeah.
Yeah, absolutely. Do you want to conclude?
Well, in conclusion, although inflation is heading down, as all indicators point to, and there's a lot of excitement about the future related to, inflation going down, we personally expect that inflation will not fall anywhere near the 2% level anytime soon. We also expect that given inflation will remain higher than normal, it means that essentially investing our money will remain even more important, because that inflation will continue to reduce the purchasing power of money, meaning that you need to have your money invested in assets in order for you to generate returns that will give you a real rate of return that far exceeds inflation. So to that end, the people who are investing in assets, in various assets, will continue to win essentially if they have their money in the right places. So we want to point to a specific video for you guys to check out, a video we made recently on 5. It's actually titled Invest in These 5 Assets and Never Work Again. We'll link to it below as well as above for you guys to head over and check it out and let us know what you think. But it was actually a popular video when we made it.
It was really good.
Okay, other than that, thank you. Oh, we'd like to see you guys in the comments actually. There's a question we had, which is, what's your current biggest concern when it comes to your personal finances in this current season? We want to know the details of what's going through your mind at the minute when you think about your money. So please jump in the comments and let us know.
Other than that, guys, thank you so much for watching. Please do share this video with someone who you might think will find it useful. Like, subscribe, all the good stuff. And like Ken said, comment. Let's just have a discussion. Other than that, in all things, be thankful and seek joy, guys.
Take care. Bye.